Hi there, welcome to kneppyinvests. Every single trading day there is a plethora of announcements released to the market, and we just don't have enough time to go through all these announcements to see if there's any announcement that is of interest to you or me. So what I tend to do is weed out those non-price sensitive announcements and just focus on those price sensitive announcements that are financially related. For instance, a trading update or an earnings profit downgrade or upgrade. But even then, I am going to see some announcements that's going to go past me and I won't actually look at. And sometimes the market will see these announcements and we'll see the share price of a company increase by quite a bit. And it might take me a few days to come across the reasons behind the share price increase for this company. In this video, what I'm going to do is give you 5 companies that released an announcement during the week that impressed me or impressed the market. One company in particular, share price rose up 100% in the week, and I completely missed the announcement. The market did not, however, so I've called out now, and I'll just discuss this company because I do have a bit of a history with this company. One of the companies I'll be featuring in this video, I actually included it in the first edition of this series. So this will be Kneppy's ASX Stocks of the Week Part 2. And in Part 1, I did feature one of these companies. However, they did release an earnings upgrade during the week and it did impress me. And that company is Avita Medical. So let's get stuck into it and look at Avita Medical's announcement that actually did impress me. I won't go into too much detail about Avita Medical and what they do. However, on the June the 16th, they did release preliminary fourth quarter financial year 21 results. And this was a revenue upgrade. So previously, they were guiding revenue to be between about 8.2 and 8.6 million. They've increased that to a range of 9.5 to 9.7 million. So that's a significant increase in revenue. However, if you do look at that expected revenue for the quarter, about $10 million, and just look at the market cap, 665 million, you could say, well, there's a lot of froth built into the company's share price at this point in time. However, the trailing 12 months revenue is 30.8, so they are looking potentially a run rate of $40 million in revenue over the full year. When I mentioned this company in the previous video, I did say one of the things that is holding me back from buying into this company is the market cap or the valuation of the company and the fact they are burning through a lot of cash. However, management have stated they are trying to fix that and are trying to pare back the costs in the company. The other thing is that expected revenue of 9.5 to 9.7 million includes 6 to 6.2 million of resale commercial revenue, which is a 55 to 60% increase on previous corresponding period and a 30 to 34% increase quarter on quarter, which is the exciting thing there. If they can maintain that increase of the resale commercial revenue over the next few years, that quarter on quarter increase, this would be an exciting period for this company. And maybe that's why the valuation of Avita is quite high, because the market sees the potential of this company and the potential for their revenues to increase at fantastic rates. When we look at Avita's chart over the past 2 weeks, we can see a potential breakout in the share price. And that's been really helped by 2 positive announcements in a 5-day period. I've already talked about the June 11 announcement where we saw the share price increase 10% and reach the 50-day moving average. And then on June 16, they released that revenue upgrade. The share price rose 12% on that day. And then next 2 trading days, the share price went sideways. So I'm going to be keenly watching the share price over the next few days to see if the share price can consolidate or even move into an uptrend. I was interested in Avita if we go back to around January of this year because it looked like there could have been a breakout in the share price. We saw the share price run up from about $5 all the way up to past $7. However, that potential breakout failed. There wasn't any real positive news with that or coinciding with that run up. However, we do see that 2 positive news events with this potential breakout, and that's a much more powerful sign of a potential breakout when you have coinciding positive news events with the share price breaking out. So keeping a close eye on Avita. The only 2 things holding me back, as I've mentioned before, is the valuation of the company and the fact they do burn through a lot of cash. Onto a company that I don't really follow that closely. A lot of other media companies I probably stay well clear of. I'm probably of the mind and the opinion of a lot of other investors out there that this is a dying industry. However, in saying that, if a few of these companies, I'm talking about Seven West Media and Channel 9, can diversify their revenue streams and increase the revenue in those streams, they could come out on the other side of these headwinds they're facing right now as a successful growing company. Now, I'm just keeping in mind that I personally don't watch commercial TV anymore. I don't watch 1 minute of commercial TV. Any TV shows I want to watch, I can find other ways to watch that. So I don't have to watch commercial TV. And there's going to be a lot of other people like me out there. In fact, I'd say it's going to be an increasing number of people who won't be watching TV the traditional way we used to do it, when we just had a choice of 3 or 4 channels to watch, and that was it. So these companies, it's very important that these companies find ways to change their business model. The reason why the market became interested with Seven West Media on June 17, they did release a trading update. Now, this trading update was, we'll call it an EBITDA upgrade. And it wasn't an EBITDA upgrade based off previous guidance from the company. It was compared to analysis expectations. So the company released their expected underlying EBITDA for the financial year was going to be between 250 and 255 million. And that compared quite favorably to what the analysts were expecting. They were expecting EBITDA to be between 235 and 245 million. And that's fairly important because a lot of the valuations of this company would have been driven by the analyst expectations. So now fund managers would have to do a revaluation of Seven West Media based off the expectations of the company. So the valuations of Seven West Media more than likely would have risen because of these new expectations. And that's why the share price jumped up by a fair bit. We'll see that jump up in the share price in the next slide. The other thing I just want to do is compare the EBITDA numbers to previous years. Last year, it was 134 million. So we will see EBITDA jump up significantly in the previous year. However, if we go back to financial year 19, EBITDA that year was 264 million. So EBITDA is dropping if we go back 2 years. And the same thing is happening with revenue for Seven West Media because advertising is decreasing. Less people are watching TV. And if less people are watching TV, that means the revenue stream for the advertising will have to drop. And you can see that with the revenue numbers. I won't show it here, but revenue is dropping. Market cap for Seven West Media, 761 million, not too high. And revenue, 1.1 billion, which is dropping. And operating cash flow, 116 million. And based off the market cap of 761, I would not say this is overly cheap. What I usually do is just times operating cash flow by 6. And in this case, if we do that, we get a total of just over 700 million. Anything less than that, there probably would be some good value there. And this trading update actually increased the market cap and pushed Seven West Media just above what I could call really good value. One good thing the company is doing is decreasing their debt. So the net debt in financial year 19 was 564 million. They decreased that to 398 million in financial year 20, and now it's going to be decreased further to 240 to 250 million. That is definitely one positive when you look at this company. Onto the chart for Seven West Media, and this goes all the way back to 2019. They released their results in August of that year on the 20th. Share price was down 5%. Around that time, share price was 37.5 cents. So in fact, the share price is higher now than it was back then. We can see a massive downtrend from 2020 to the heights of the COVID-19 financial panic, when the share price was as low of about 6 to 7 cents. Based on valuations of the company at that point in time, that could have been a good time to buy in. Then the share price went slightly higher over the next 6 months, but the breakout in the share price definitely happened in October, around about 12.5 to 14 cents. Just after they released their financial year 20 results on the 25th of August, share price on that day decreased 16%, so it did not impress the market. The market, however, is forward-looking, and that's why we did see the share price breakout in October, and that rally in the share price from that point in October, which was around, we'll say 12.5 cents, lasted about, we'll say 4 or 5 months, and it reached a high, or the share price reached a high of 58 cents in February, just when they released their half-yearly results. Share price then went down, and then with this trading update on the 17th of June, the share price rallied 24% on that day. So the market loved this announcement. So there is a bit of excitement in regards to Seven West Media. Even though there is a bit of excitement, I am at this stage staying clear. If I was to buy one of these companies, it would be Channel 9. However, even Channel 9, I'm staying clear. The only way I'd buy Seven West Media would have been if the share price was down really low levels, like it was back between April of 2020 and October 2020, when the share price was less than 12.5 cents. The next company I want to talk about is Payright, a buy now, pay later player, fairly small one. I didn't really know this company existed, even though they IPO'd on the 23rd of December. So they've been on the ASX for about 6 months now. Usually when a company has been on the ASX for that long, I do eventually come across it. This is the first time I've paid a little bit of attention to Payright. So it didn't really impress me, this announcement. It didn't impress the market. However, it's a new company, and I just wanted to talk about it in this video. And you can just see the market cap of Payright is at 48 million. For buy now, pay later, that is quite small, but this is a very small buy now, pay later player on the market. I do believe most of these buy now, pay later companies won't survive in the long run. It reminds me of, say, the car industry in the 1900s. When cars or automobiles first came into existence, there were so many car manufacturers. It's like thousands of car manufacturers saw their opportunity because this sector or the car industry was going to grow, but eventually only a few survived. I think that's going to happen with buy now, pay later. A few will survive, and those who do survive will be successful. But most of these buy now, pay laters won't survive. Very similar to cryptocurrency right now. There are a plethora of different currencies on the market right now. It's just increasing every single day, and only a few will survive in the long run. Now, one of the things I did with Payright is I just wanted to compare some of these numbers to Afterpay. You can just see the massive difference between one of the biggest buy now, pay later companies in the world to one of the smallest, Payright. For example, merchants for Afterpay, 75.8 thousand. So 85,800 merchants. Payright has 3,400 merchants. Customers, Afterpay has 14.6 million customers throughout the world. Payright has 52,500 customers. The market cap for Afterpay is 31.2 billion. Payright has a market cap of 48 million. So very small company here. However, just because it's small doesn't mean it won't survive. Maybe Payright will become the buy now, pay later we all use in the future. I think the possibility of that is fairly low. So if you do like buy now, pay later, maybe have a look at Payright because it is potentially good value at these prices. When we look at the Payright chart, going back to when the IPO, back in early, or actually it's late December 2020, we have seen generally the downtrend in the share price. There was a little bit of excitement in Payright in February. More than likely that was around the half-yearly results. We did see the share price rise in 2 consecutive days from 80 cents or so, or just above 80 cents, to a high of about $1.20. But ever since that high of $1.20 in February, the share price has been pulling back. In fact, it's gone from $1.20 to a low of around 43 cents, and that was reached in late May, early June. A little bit of excitement came into the market for Payright in early June. We did see the share price rise from 44 cents to 58 cents. And when they released this trading update on June the 15th, the share price rose 7%. However, it has pulled back a little bit over the last few trading days. Share price did reach the 50-day moving average at a high the last few weeks and has pulled back. Typically, not always, but a lot of times, the 50-day moving average does tend to be a bit of a resistance level. So it does look like there is potential of the share price turning around, but this is very true for a lot of other buy now, pay later companies right now. If you had to ask my opinion on Payright, I would say if you do like buy now, pay later, probably better to maybe buy into some of the other companies. I'm a little bit partial around Zip. I do believe that's much better value than Afterpay. That would be my preference in this field. But you just don't know. Potentially, Payright could be the successful buy now, pay later company if management, succeed in raising the profile of this company in the future. We just don't know at this point in time. Fourth company I want to talk about is Bubs. This is a company that does create baby formula using goat milk. So that's one of the differentiations between Bubs and other baby formula manufacturers. On June the 18th, they did release an announcement in regards to them launching into the US market on the Walmart e-commerce platform from September of this year. The market absolutely loved this announcement. Didn't really hurt that there is a little bit of short-term excitement in a lot of these companies, these baby formula companies like Bubs. A2 Milk is also seen a bit of a rise in the share price over the past few weeks, and also Synlait Milk. And there is a reason behind that. I'll talk about that in the next slide. Bub has a market cap of 230 million, revenue of 46 million, so it's fairly low, and operating cash flow negative 21 million. So hopefully this launching into the US market will help their financial state. This is not the sort of announcement I do get excited about because this is not financial related and there's no numbers around this. We don't know how successful they're going to be putting their products onto the Walmart e-commerce platform. It could absolutely fall flat. I like to see some proof that this expanding into the US market is working. They are spending a lot of money to do this, so they are expecting this to be successful just because of all the money, capital expenditure they're putting into this launching into the US market. The chart of Bubs looks very similar to other similar sort of companies like A2 Milk, Synlait Milk. We've seen a well-defined downtrend that's lasted about a year or so. Go back to July, August of last year. Share price of Bubs around that time was over $1, and it's pulled back all the way to a low of just above 30 cents. And that low was reached in the middle of May. However, since that low in the middle of May, so over the past month or so, we have seen a rebound in the share price. On June 1st, share price rose 22% on no news. Bubs was given an ASX price query. They did have to try to explain that. And then explanations around that rise in share price is all to do with China and the fact that China has gone away with their 2-child policy and it's now up to 3. So Bubs believe that is going to help them in the long term. And then when they released this announcement about them launching into the US, share price rose another 29%. So a lot of excitement right now in Bubs, but we're seeing a very similar thing also with A2 Milk and Synlait Milk as well. Both of those companies' share price are rising just like we're seeing with Bubs. I'd say Bubs' share price rise is probably the most impressive. And this share price increase of 29% on June 18 looks like it could be a breakout in the share price. So if you are keen on Bubs, maybe now is the time to buy into this company just because of the breakout in the share price on some positive news. It's not really the sort of news announcements I would buy into for a breakout. I would rather see a profit upgrade or a trading update. Final company I want to talk about is a company I do have a little bit of history about, not really over the past 6 years, but Fertoz IPO'd on the ASX in 2014. And around that time, I decided to take a little bit more interest in IPOs to see if these are sort of companies I want to invest my money. So I decided the first company I actually looked at was actually Fertoz, which if you just take this company, Fertoz, is an organic phosphate fertilizer manufacturer and supplier. So just break down their name, fertilizer, Australia. So Fertilizer Australia, Fertoz. Anyway, I did a bit of research in this company. They followed their fortunes for about first year they were listed on the ASX. They weren't really successful in that year, so I've ignored them ever since until they released this announcement to the market on June the 17th. Positive results enhance Fertoz's carbon market profile. Not really the sort of announcement I would get too excited about, but the market loved this announcement. In fact, the share price rose 100% in 2 trading days. We'll have a look at that in the next slide. You can see even though the share price rose a significant amount, the market cap is still only 30 million, so not a lot of revenue, and they are still operational cash flow negative. However, what they've mentioned here in this announcement, applying Fertoz's rock phosphate alone or in blends offers fertilizer companies a practical way to reduce their greenhouse gas emissions and bolster their plants' nutritional requirements. I think that's the reason why the market got excited about this. all about that reducing greenhouse gas emissions. And any company that can show their products can do that, I think the market will absolutely love in the future. So this is probably why the market really pushed up the Fertoz's share price over the past 2 trading days. So now let's have a look at their chart from the time they listed on the ASX. This is the weekly chart for Fertoz, going all the way back to 2014. It's their share price at the peak of the excitement with Fertoz rose as high as 65 cents just after they IPO'd. In fact, for the first 3 weeks, the share price rose a massive amount. In fact, it almost tripled. So you can see sometimes when a company IPOs, there's too much excitement with what they do. And after that excitement wanes, a lot of times you'll just see the share price just drift back by a fair bit. In fact, it did. Share price drifted all the way from that high of 67 cents or so, went to a low of about 5 cents in August of 2017. We saw a bit of excitement come back into the market during 2018, went back up to 25 cents, and then it drifted down again and went back to a low of 5 cents. And that low was actually reached just before they released this announcement. And the share price has gone from 5 cents to a current share price of 16.5 cents. So it actually has tripled in about the last week or so. And the share price rose 45% on the day they released this announcement. And then the next day on June 18, the share price rose 50%. So this is a company you want to keep a close eye on, because even though there's no financial numbers, the very fact that their products does reduce greenhouse gas emissions is exciting the market. However, I'd prefer to see some financial numbers in there. I'd prefer to see them growing revenue, becoming operational cash flow positive before I take a position in this company. The only reason I might take a position is just because of the positive sentiment around this company. That is all I have for this video of Kneppy's ASX Stocks of the Week. Edition 15th to 18th of June 2021. Happy birthday to my father, who had a birthday on the 19th of June. Unfortunately, his birthday fell on the same day I've decided not to release a video. So I've decided only to release 6 videos a week and have 1 day off. If you have anything to say about any companies I've featured in this video or any other company on the ASX, leave a comment or question and I'll answer anything you have to say ASAP. And the last thing I should just mention is I'm not a financial advisor, so if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. Talk to you later. Bye.